ACEO from Wall Street has recently issued a dire warning to the 330 million Americans regarding the future of the country. The CEOs of major banks like JP Morgan, Bank of America, Citigroup, and Goldman Sachs testified on Capitol Hill to oppose the proposed changes to regulations by the Biden administration. The effects of these changes are already starting to show, evident in the recent bank layoffs. For instance, TD Bank has laid off 3,000 employees, Citigroup has laid off 24,000 employees, and Bank of America has fired 7,500 employees. The significant number of layoffs suggests that more job cuts could be in the pipeline. As of this year, over 50,000 bank employees have been affected. This raises the question, why are these layoffs happening? To understand the situation, let's examine the warnings issued by Jamie Dimon and other bank executives. It becomes clear that the banking system is undergoing substantial changes, which will likely result in a decrease in various asset values, including property and car values. These changes include new rules, regulations, and alterations to the banking system. Now let's break it down. The injection of a massive amount of money into the economy in 2020 and the subsequent encouragement of borrowing created a setup that ultimately benefits the banks. However, these new regulations have limited borrowing opportunities for the majority of people, thus leaving them locked into significant debt that they are unable to fund. As a result, an increasing number of individuals will default on their loans and be forced to sell off their assets. This situation presents an opportunity for those who are in a position to buy these assets at a reduced price. However, access to funding will be limited to individuals with the best credit scores, finances, and strong qualifications. Therefore, it is crucial to position oneself accordingly. In a recent development, Wall Street CEOs have voiced their concerns regarding proposed regulations aimed at increasing the capital requirements for banks. During an annual Senate oversight hearing, the CEOs of 8 major banks presented their prepared remarks and responded to questions from lawmakers in an attempt to raise awareness about the potential impacts of these changes. The proposed regulations, known as Basel III Endgame, were introduced by U.S. regulators and encompass a comprehensive set of higher standards for banks. If implemented without modifications, these rules would result in a significant increase in capital requirements for banks, estimated to be around 25%. The CEOs argued that this would have adverse effects on the economy, financial markets, businesses of all sizes, and American households. JP Morgan, Bank of America, and Goldman Sachs, among other major banks, sought to downplay the effects of these new regulations, primarily because they would affect all U.S. banks with assets of at least $100 billion by 2028. They expressed concerns that these rules would lead to tighter bank lending in each subsequent quarter. Additionally, the CEOs warned that the increased cost of capital could negatively impact industry's profitability and growth prospects, potentially benefiting non-bank players such as Apollo and large private equity firms, who may gain market share in areas that become less accessible due to stricter regulations. This includes loans for mergers, acquisitions, and highly indebted corporations. While the major banks can currently meet the regulations as they are currently constructed, there would still be both winners and losers. This contradicts the notion that these regulations are intended to combat inequality. Strong businesses and borrowers would be able to access capital more easily, while everyday Americans, including small business owners, mortgage customers, pensioners, investors, and those in rural and low-income areas, could face challenges in accessing loans and mortgages, which might become more expensive under the new rules. Furthermore, the CEOs discussed the potential consequences of a significant reduction in interest rates. Contrary to some expectations of a Federal Reserve pivot and a subsequent decrease in rates, they warned that such a scenario would lead to an explosion in home inventory. This surge in supply would inevitably impact property values due to the resulting imbalance between supply and demand. In fact, between 2020 and 2021, 40% of all mortgages in America were contracted at rates ranging from 3 to 5%, further emphasizing the potential repercussions of interest rate fluctuations. In the near future, there are predictions that the housing market will experience a crash. This will be compounded by the increasing difficulty in obtaining loans and borrowing money, as well as the rising cost of borrowing. Home buyers will face significant challenges, but even more so for home sellers as insurance and taxes continue to escalate. Accessing capital to pay for mortgages will become increasingly difficult. CNBC and MetLife Insurance have projected that by 2030, institutional investors will own 40% of all homes, a significant shift in ownership. The rise in cost of capital will also impact government infrastructure projects, making them more expensive to finance. This will result in higher costs for hospitals, bridges, and roads. Corporate clients will need to pay more to hedge the price of commodities, leading to increased expenses. Farmers and rural communities will bear the brunt of these changes, affecting their mortgages, credit cards, and overall cost of borrowing. In addition, the heightened oversight on banks will push financial activity to non-bank players, known as shadow banks, potentially leaving regulators blind to the associated risks. According to HUD.gov, an estimated 23% of Americans currently owe more on their mortgages than their homes are worth, indicating negative equity. This is particularly concerning considering the financial state of many individuals, such as retirees and those on fixed incomes. The cost of living is soaring, which has resulted in decreased 401k hardship balances and an increase in hardship withdrawals. Nearly a third of households headed by seniors are considered cost-burdened, spending more than 30% of their income on housing. Harvard research further supports this, revealing that the number of older households facing housing cost burdens is growing. Rising property taxes, utilities, and insurance fees contribute to higher costs, which pose unique challenges for older adults on fixed incomes. While some states provide property tax relief for older homeowners, the assistance offered varies and can often require deferred tax payments upon the home's sale, ultimately leaving homeowners with lower sales proceeds for other needs. Retirees and everyday Americans are facing significant troubles, and access to capital is becoming more strenuous. It is essential for individuals to make wise decisions and strategize during the next few years. This includes getting out of high-interest rate consumer debt and building a strong financial foundation. As the world becomes more difficult to navigate, it is crucial for people to stay informed about these ongoing challenges. Approximately 79% of Americans over the age of 65 own their homes, which accounts for a total of 27 million owner-occupied homes out of 33.9 million. It is emphasized that these individuals rely on fixed incomes, making it increasingly difficult for them to cope with the rising expenses. In fact, a third of retirees are already facing financial burden due to present-day expenses. Suggestions provided for retirees include creating a diversified income stream from various assets, minimizing debts, sticking to a budget, careful planning, and reducing family and financial obligations. However, it is acknowledged that these suggestions may not be enough to alleviate the financial strain on retirees, and many will likely resort to selling assets and downgrading their expenses. The focus then shifts to the financial situation of the broader population beyond retirees. Consumer loans have skyrocketed while consumer deposits have significantly declined. As of August 2021, consumers held $2.1 trillion in deposits, but that figure has dwindled to just $190 billion as of September 26th, approximately 2.5 months ago. These numbers do not even account for the impending due dates for student loans, which were only 4 days after the article's release. In essence, approximately $1.91 trillion has been depleted within a span of 27 months, leaving consumers with a mere $70 billion. Even by factoring in anticipated burn rates, it is predicted that consumers will exhaust their remaining funds by the end of this month. This financial crisis will inevitably place immense pressure on banks as well as individual consumers. As the situation unfolds, it is crucial for individuals to be proactive in managing their finances and finding innovative solutions to mitigate the negative impacts of the impending financial turmoil. I urge you to prepare for the potential negative impact on the American middle class. They stress the importance of taking proactive measures, such as establishing businesses with low expenses and maintaining cash reserves. It is crucial to adopt a defensive mindset at this time. I actively encourage you to share your thoughts on these issues and engage in a conversation in the comments section below the video.